Okay, here we are. We're on the back of the 1040 now. We have Don Johnson. So we went through the first part where we talked about income and adjustments to income. So on the back of the 1040, page 2, we find line 38, which is the adjusted gross income. So the adjusted gross income here is 23,152. On line 40, we have itemized deductions or standard deduction. And in this situation, we took the standard deduction, which is $6,200. So let me show you how this works. On 1040, page 1, he's single. But we're going to change him from single to head of household and see what the standard deduction is for head of household. And how we do that is we go to the main information sheet. This is the parent form, so the changes on this form affect all other forms. So as we go down and we see filing statuses and exemptions. So I'm gonna go ahead and just click on head of household, and you always tab because it caused the calculation to take place. So I selected head of household. Now I'm gonna go back over to the forms tree right over here, and I'm gonna click on 1040 page 2. Now when we go to line 40, we see that it went up $9,100. So when you're selecting a filing status, what is actually taking place is it's calculating an amount, which is called the standard deduction. Okay, so for 2014, it was 9,100 for head of household. Let's go back to our main information sheet and let's do married filing jointly. Okay, that's selected. I'm hitting tab. Now I'm going to go back to the 1040, page 2. So the amount for married filing jointly is $12,400. And while we're at it, let's just go ahead and run back here, main information sheet. You will notice that when I did married filing jointly, it's asking for the spouse's information and birth date. However, I'm just going to go ahead and scroll down. Married filing separately, tab, and it's asking for the spouse's information here. However, we're going to go back to 1040 page 2. And the amount for married filing separately is $6,200, the same as single. So that's called our standard deduction. Itemized deductions take place primarily when a person owns their own home. And that requires a special form. And that form is the Schedule A, which is right here. Now, all your forms, of course, we pull up from add, and then we, if you didn't remember, it's not showing up because I already have it pulled up. However, that's how you pull up your forms. I'll go ahead and just delete it for this example. I'm going to add a Schedule A, and it came right up at the top. When you think of itemization, think of Schedule A, and A is shaped kind of like the roof of a house. Okay. Now, on this itemized form, all the deductions that we put here, they're going to calculate and come up on line 40. So the biggest deduction that you have here, you have medical and dental expenses, taxes you paid, then you have interest you paid. So most of the time, you'll find individuals, their mortgage interest is in the thousands of dollars. Some are low, but many are, 6, 7, 8, 9,000, 10, 11, 12,000 and up. In this situation, we'll put $12,000. We're going to go back to the 1040 page 2. And there's our $12,000. You take the itemized deductions when the itemized deductions exceed the standard deduction. So let's go back to the Schedule A. We have medical and dental expenses. However, we rarely use this because it has to be more than 7.5 of your adjusted gross income. So let's say for an individual who made $100,000, their medical expense would have to exceed $7,500. It starts calculating once you get past 7,500. So if they paid $4,000 and $5,000 and $6,000, it's not going to calculate. However, let's say they made $8,000, only $500 will begin to calculate. So once you hit that 7.5% of your income, everything over that you can write off. Taxes you paid. Let's go to the W-2 form because it's going to show us taxes that we paid. On the W-2 form, if we go down to line 15, there's nothing here. However, we'll put the state of Georgia. Let me just check and see what state he's actually out of. Okay, Georgia. I went back to the main information sheet. I looked at the address here, and it's showing that he is in Roswell, Georgia. So I'm going to go back to the W-2. I added my Georgia forms, which popped up over here once I put Georgia in line 15. Line 16, the wages popped in automatically. We had 12,000 as the wages as well on line 1. So that amount pops up down here in 16. 17, we'll put our taxes. Okay. So now we have the taxes on the form, the state tax. Now we're going to go back to our Schedule A. Here's the $750. It pops in automatically. You write off your taxes you paid, your ad valorem tax, any taxes you paid to the state, you can write that off. That's a deduction. We go down to interest you paid. That's for the home. Then points, you can write off points that you paid in your mortgage. You know, sometimes you pay a little bit more to get the interest rate down. Whatever that amount is, you can write that off as well. That comes here. Gifts to charity. The max you can do as far as cash without receipts is $500. Other than cash, $2,500. You'll see a lot of tax preparers, they'll just put that there. We don't need any information from the client to do this particular deduction. However, when it exceeds this amount, then we have to get some receipts. We have another one here, casualty and death losses. So you can actually write off items that may have been damaged or destroyed in some type of a natural disaster, fire, some type of accident, someone broke in the car or broke in the house. We fill out this form right here, 4684. And let's go ahead and pull that form up. So I'm going to just go here, 4684. And it gives us our form here. It's actually 3 pages to it. It's actually 5. However, I'll just go ahead and click on one. And this one is actually dealing with properties. I'm not going to go too far into that. So I'll go right back to our Schedule A. We're dealing with itemized deductions now. You take your itemized deductions in place of your standard deduction when your itemized deductions exceed that of the standard deduction. We talk about interest, we talk about gifts to charity, casualty and death losses, job expenses, and most other miscellaneous deductions. Okay. 21, unreimbursed employee expenses, job travel, union dues, job education. So basically, if you're working somewhere and you have to do any type of continual education, you pay in union dues, you have to travel for the job, you had to buy boots, you had to buy, pants or whatever the situation may be. Anything that you spend for your job, you can write that off if you're itemizing. Not if you're taking the standard deduction. People say, I had to buy some stuff for work. You can't write that off unless you're itemizing. So we go down a little bit further. Look at that, 22 tax preparation fees. You can even write off your tax preparation fees. Other expenses, investment expense, safe deposit box, etc. Uh, Miscellaneous deductions. A lot of these, this area right here, I've probably never ever used. It's always the mortgage. These are the lines we always do, the state taxes, and then we get their mortgage interest paid. Then we go down to gifts to charity. Sorry about that. Then we go down gifts to charity. Then casualty and theft and losses, job expenses, most other miscellaneous deduction. These are the ones we fill in primarily. In some cases, we go here. However, this is your Schedule A, itemized deductions. So back to the 1040, page 2. So we covered line 40, itemized deductions or standard deduction. So these deductions, what happens is it reduces your taxable income. In this case, it's $23,152 minus $15,000 in deductions, $15,750 to be exact. That brings the income down to $7,400. Then you get an exemption. And what an exemption is basically an amount, and in this case, it's $3,900. So you get a personal exemption, and you get an exemption for each one of your dependents. So in this case, $3,950, that's going to subtract from this amount as well. So the income now, his taxable income is only $3,452. So he went from $23,000 in income to only having a taxable income of $3,452 because of the itemized deduction and his personal exemption. I'm going to take this Schedule A off. I'm going to go delete my amounts I put here. I'm going to delete the $12,000 because it's not going to calculate it, automatically default back to the standard deduction, which is $6,200. Now look at the income, $23,000. You subtract $6,200, brings us to $16,952. Then you have his personal exemption here, $3,950. So his taxable income is $13,000 now. Now, when we look at the tax table, what is happening here is taking this amount and it's calculating it up against the tax table. And I'm going to show you the tax table from the IRS. Here is our tax table from the IRS. So basically it shows you your income brackets from $0 to $55. If you claim no exemptions, or you claim 1, or you claim 2, 3, 4, 5, 6, 7. When you fill out for a job application, they ask you how many dependents you have. That's what these numbers are. However, at $50, you don't owe anything. You start seeing some tax generating once you get to $100, and then from there it just goes up. $4,000, $400, $500. You see those taxable amounts here based on the number of dependents that you have. All the way here, this person claimed the max. He said he had 10 people. So of course they're not going to take any taxes out. However, when you're down here around 1 or 2 or 3, they'll start taking a little bit taxes out the income. I'm just scroll a few pages down. I'll make this available for everyone. When you start getting around, of course, this individual is up there. This is $2,900. Here's the taxes if you don't do any dependents or exemptions. If you claim 10 people, this is how much taxes they will take out. Okay. However, it's a form that actually calculates your tax liability. So once that amount calculates here within the program, it determines your tax amount. And in this case, it says he owed $1,500. So here we go. Here, this is his taxes. Now, what takes place is once the taxes is calculated, then we're going to look at some other areas. In this case, this individual had a Schedule C on his tax return. So it's showing self-employment tax. This is more money that he would owe. Anytime you do a Schedule C, here we go. I'm going to click on this Schedule C in the forms tree. Anytime you do one of these Schedule Cs, which is profit or loss from business, and you put an amount here, it's going to calculate a tax. If you're reporting money, you're going to have to pay taxes on it. So I'm going to just go ahead and take that out of here for now. Let me just click on this. Delete this whole form. Voila, it's gone now. So we go back to our 1040. His income came down quite a bit once I did it. You know, it was $12,000 on that Schedule C. So you see here, it reduced that amount. Now his AGI is $12,000 based on the W-2 that we put on the tax return. His standard deduction, $6,200, bringing his income down to $5,800. That one exemption he got for his personal exemption brings his income down to $1,850. So this is his tax liability, $186. That's his tax. Line 44 shows you the tax that they owe. There's some other calculations here. I never see anything take place on these lines. You know, in rare cases, we might see something here. We get here to credits. They have non-refundable credits. The primary one that we deal with is credit for dependent care expense. It's a form that we fill out for people who have, it's the form 2441 for people having children. So I'm going to pull that form up. And when we look at the form, page 1, click on it. Credit for child and dependent care expenses. So persons or organization who provide the child care. So they want the child care provider's name right here, the street, the EIN number or the social, just in case that's a person. It could be an aunt, a cousin, or grandmother who's watching the child, and then the amount paid to them. But once we put this amount here, which we will not do now, it is gonna, let me see if I put something there to calculate. Sometimes you have to have the whole social and everything for it to calculate. But let's see. Qualified expenses, I'll put $2,500. I'm gonna go back to the 1040 page 2 and see if it calculated anything down here for us. It didn't calculate because it has to be a child on the main information sheet. It will calculate an amount, and that amount will come here, and it will further reduce your tax liability. That's what a non-refundable credit is. It's a credit. It don't give you money like the earned income credit. The earned income credit is a refundable credit. That means that the IRS is going to give you money based on your income to bring you above the poverty line. So our low income people get a refundable credit. However, a non-refundable credit is amounts that actually reduces your tax liability. It doesn't give you any money. So we have education credit here. That's another one that we see. Child tax credit, we see that as well. Most of 80% of the time. This retirement savings credit, we see that sometime. Other taxes, as I showed you before, self-employment is a big one. Anytime you do a Schedule C, you're going to see an amount here. So Social Security, Medicare tax, you know, we really don't see a lot of people owing taxes in this area. You know, additional tax on IRAs and qualified retirement plan. I never see any of this down here. 90% of the people won't have this. 95% of the people won't have anything in this area down here. This stuff right here, I never seen any of this calculate. I don't even know what it is, to tell you the truth. I can tell you it's related to retirement plans, but in all my years doing taxes, I never really had to do anything in that area. Now this is where we get down to the payment section. So we have our federal income tax withheld. There's nothing here due to the fact that on the W-2 we don't have anything in the tax area. However, I'll put $900 there. Most people are in the 10% tax bracket, so I'll put $1,200 there. Sometimes you hear me when you're doing, problems or mock returns. I'll say, put $1,200 or whatever the case. I'm basing that on the tax rates. Go to 1040 page 2. We go down to the payment section and look, there's our $1,200. Everything showing up down here is going to be a credit to the taxpayer. So we see it here, and we also see, we're down in the payment section on the 1040 page 2. So in the payment section, you're going to see your federal income tax withheld, which is $1,200. When we added that $1,200, we actually got a refund over here on the refund monitor. When we added that federal income tax withheld, it actually created a tax return. Okay, now we're going to take a look at Earned Income Credit here on 66A. This is a big one. The Earned Income Credit was a program that was designed by the federal government that brought low-income people above the poverty line. So in a lot of these cases, one child can yield about $3,500 in Earned Income Credit. And I will show you how that works. There's an Earned Income Credit table, which is here. Let me scroll up on that. Okay, there you go. Earned Income Credit table. This is 2014. However, if you look in this area right here, I want you to focus down here. It says the at least but less than. So these are brackets and they're $50 intervals. So a person earning between $1 and $50 with no children would get $2. With one child, 9, 2, he would get $10, and 3 children, he or she would get $11. So that's how that works. So the numbers just go up. Over here on the right hand side is from $2,800 to $2,850, and here's the credits respectively. With no children, 1 child, $961. With 2 children, $1,130. With 3 children, $1,271. We're going to look at some higher amounts range. I'll leave that alone. So a person earning between $9,200 and $9,250 by themselves, $410. With 1 child, $3,137. With 2 children, $3,690. With 3 children, $4,151. So you see it goes up quite a bit. And this is money. It's called a refundable credit. This is money that the government is going to give to the client. We're in the $16,000 range, and it starts to phase out here because for 1 child, we saw as high as, what's that, 33? This column I'm looking in right here, so it can get kind of $3,300 for 1 child. That's the max that we're seeing on the Earned Income Credit. Between, what's that? It starts at, I hope I'm not confusing you here, but I'm looking at this column right here, and I'm looking at the income. So 9,000, 3,300, 10,000, 11,000. We still see 3,300 over here for 1 child. So from 9 or 10,000 up through 16, 17,000, we're seeing 3,300 for 1. $5,400 for two, and $6,100 for the third child. So this is the earned income tax table. Just like the tax table, it's a form that shows you income brackets and then that particular tax rate or credit. In this case, it is a credit, and a credit is money. This is a refundable credit, so the IRS is giving this amount of money to the taxpayer during the tax season, or when they receive their tax refund. So we see clients that have tax returns $6,000, $7,000, $8,000, and I'm going to give you an example of that. I'm going to go to the main information sheet on Don Johnson's return, and I'm going to go down to the dependent field. If we have a dependent on the tax return, we have to select head of household. Now this will pop up over here. You only put the child name here if someone else is claiming them as a dependent. However, in this case, we'll be claiming them as a dependent. So we'll put Jane, and use uppercase, Jane Johnson, and I'll put 0101, let's just say 2010. We'll put the social there. The relation is daughter. The months in home is 12. This code right here, of course, you've been through it, so it's 1. This is for dependent care. We talked about the 2441. It's automatically on the form here. This is the dependent care expense. Now I'm going to hop back to the main information sheet. So, of course, I'm pretty sure you all been through a problem that actually required that. However, we're going to check earned income credit, and you always want to do that. So with one child, see the return, it went up to $5,500. Now this is someone who AGI is $12,000. However, their refund is $5,500. So in this type of return, these are the type of returns where you can really see $300 or $400 even in a tax prep fee. So our fee is right around $250. It may be about $300 when you use a Schedule C. That automatically attaches a $100 fee to it. Let's just say he had another dependent. So this is how the earned income credit works. Okay, now the refund went up to $7,300. And it's as simple as that. Once you really get your hands in the tax preparation industry, you're going to see how the Schedule C work. You have the opportunity to see on some returns. You'll see them on the ones that you're going into, based on their income. A Schedule C can, if they have some type of business, we could actually, it could benefit them in terms of increasing their refund by either a loss or addition to income. So we talked about that on some of the videos that you were working on. As we go into the other 5 videos, you'll see how that will take place and how you can make a $400 or $500 in income from a Schedule C tax return. Now I'm going to go back to the 1040 page 2. And as we scroll down, we see actually from the earned income credit, it was $4,810. And from the additional child tax credit, that's another credit which is refundable. And for the two children, they receive $1,350. The additional child tax credit is $1,350. So wow, when I first learned this business, I was like, this is amazing. Once you learn it, it takes you about 10 minutes, 20 minutes to get the information in there. It takes about 5 minutes to actually for a return to actually calculate. And you're in the money, as they say in the trading industry. So that's it. Down here on line 75, amount overpaid, and 76, amount to be refunded. Here is your refund amount there. If he had old money, it would come to this line right down here, and it's as simple as that. So that's it for this video. Thanks for watching.